Welcome everyone to the monthly market update from Principal Wealth Partners. I am Julina Ogilvie, partner and wealth advisor, joined as always by our founder and CEO, Bob Paolucci. Bob, hi.
Hello.
Well, the title this month is Spring Ahead. So can I say happy spring or we're almost there?
Early March, happy spring. The birds are chirping. Spring is a good time to spring ahead in the market because
Yes.
that's exactly what's been happening.
Yes. I think that there are a number of anecdotes, I think, in the title that we have here today. And we have 10 topics for the agenda today. Bob, if you want to quickly review them.
Yeah, we'll go through the rapid change in annual forecasts by big Wall Street firms for the S&P 500. They put out in January these price targets based on the wind, some real data, what they were feeling at the moment, and some other stuff that they say goes into the numbers. But anyways, many of them have already been revised since they put them out in January. We're going to show that to you in a minute. We also have the big Wall Street firms estimate for rate cuts, how much and when. We're going to talk about the Fed and the fact that they're running out of excuses. You know, their words have become a tool, but now when you compare their words to the data, it's decision time. So we'll then get into the fundamentals of the equity market, or more importantly, the fundamentals of these publicly traded companies that are in the indexes that make up, the S&P 500, the Nasdaq, the Dow, so on and so forth. We're going to give you a little chart of bull market behavior, something that might not feel right, but it's actually quite normal. Tax time market volatility. So we think, the market is probably due for a little breather. You can't run a successful marathon without running a slow lap or taking a step back. We think that is due soon. And it happens to be right around tax time that we typically see it. We'll talk about the new record amount of cash mountain, as we call it, and how that number is a staggering number, which also happens to be fuel for this bull market going forward. Hint, hint, there's a lot of fuel. We'll talk about something very interesting. We're going to change the tune towards the end. We'll go from a whole bunch of positive stuff to a few questionable things. Ivy League schools from bragging to begging. So typically around this time of year, you'll have the Ivy League schools brag about their endowments, how much money they have, how much they've made, and if they beat the market or not. You don't have that this year. You actually have some real issues this year in the endowment side, especially in the Ivies. You've had a combination of donor pullback plus private equity exposure, which is very heavily seen in the Ivy League endowments. That has changed a little bit. We'll get into that. We'll take a close look at the municipal bond market very briefly. We stumbled across a very unusual bond offering from New York City, and we think there's something there. We'll get into that. And then a reminder that if you didn't know, we have an election cycle ahead of us this year, and it's not just in the US. I think it'll shock you when you see how many elections and how many people will be voting in elections this year. How does that sound, Julina?
Nope, that's great. I think we should get right into it. Let's kick it off with Wall Street, right? Because every year they have their S&P target. We're not
Yeah.
even a quarter of the way through the year, and they're already changing it.
Yeah, Julina, I mean, we've been doing this for 25 years. We both worked in a prior life at very big Wall Street firms, and we have seen this happen every year, sometimes multiple times a year, like clockwork. Can you tell us what we're looking at here?
Yeah, the ones that are highlighted are some of the key firms on Wall Street that have already changed their S&P target for the year. And some of them are quite notable, especially UBS, which has already changed their target with an increase of almost 15%.
And this is Julina just in 2 months.
Exactly.
Yeah. So
And
they
I
put out
and
their forecast in the beginning of January into December
yeah.
for the full year. And you already have 40% of these firms changing their forecast. What is it? Forecasts are for weathermen or forecasts are for fortune tellers,
And
whatever one it is.
and now mind you, the S&P is up over 8% in this short time frame. So there has to be a correlation here.
Right. So we think that this entire chart will be yellow, meaning all of these firms will update their forecast. I mean, look at JP Morgan's. Then you got 4,200 for the S&P. It's almost 1,000 points off from where we are right now. It just goes to say when you hear a lot of the specialists at these firms, right? A lot of it is marketing, a lot of it is sound bites, a lot of it is, sharing snippets. It's to get you to tune in and to get you to take action. Don't fall for it because their opinions change like the wind. And this is a very good illustration of it, just showing you not even 3 full months into the new year, you already have them changing their estimates.
Right. And can I point out, we've seen in years past when they've cut their estimates when the markets have been falling.
Yeah, thankfully we don't have that chart because it's not that time, and it
Right.
shouldn't be time for a long time.
Yeah.
But you are absolutely right.
It's so very common what we're seeing. I think the next thing we want to talk about, we have been talking about the Fed cutting rates for months and months and months, but we're finally approaching the moment. Can I say that?
Mhm. We're there, and what you see here again, a lot of the big analytical Wall Street firms, they put out these public forecasts. Again, piggybacking off of the Fed's own dot plot, the chart in which they have documented where they think rates are going to be in the short and long term. This is for 2024. You see the low end forecast with 3 rate cuts, which is actually just about what the Fed has in writing. But some of the banks just say our expectation is whatever the Fed says they're going to do. Great. Then you have others saying, well, there might be more to it. So you have a range wildly somewhere between 3 rate cuts and 250 basis points of cuts by UBS, which is a staggering 10 cuts this year. I've listened to the UBS case and I get it, right? The UBS is saying, look, you don't understand high rates and what it's going to do to commercial real estate, real estate. You don't understand what it could do to the economy. The Fed shouldn't put the US economy at risk of needing emergency cuts. And if they go too slow, which they think they might, UBS is saying, let's come over the top. We think they'll get very active towards the end of the year.
Yeah.
Fair. That's a fair statement. Ultimately, the average when you do the math is just about, let's call it five cuts for the year. Is that
Right.
fair to say? Yeah, it's a rounding error. It's 4.6 cuts rounded up to 5,
Yeah.
which would be about, let's call it a little over 100 basis points.
Yeah.
So I think that's fair. And I do think that starts very soon. You can see the first cut by many is kind of split, though. It's May and June.
May and June.
We actually believe there's an outside shot that it does happen in March. Part of that, Julina, is this morning's jobs report. I didn't really care about the number. I really cared about the unemployment level.
Yeah.
And what we saw ultimately was that the unemployment level over the past quarter or so has gone from about 3.6 up to 3.9. So we're almost at a 4% unemployment level. Keep in mind, that was one of the Fed requirements, just about 3.94% unemployment level for them to cut. So let's count up the data. We've got unemployment at the Fed target to cut rates. We have inflation at the Fed target to cut rates, their preferred measure. You have some banks starting to get weak again, and you have continued stress in the commercial real estate arena. These are things that monetary policy can and the Fed can directly help with. And we think that help is coming soon. Keeping in mind, the Fed will be cutting rates from a level that is too high, their own words, down to something closer to normal. Where we think normal rates are, we should talk about that.
Yeah.
It's where the Fed says normal rates are, which is somewhere between 2.5% and 3%.
And my only point on this slide was that if you look at the date of when these were published, they were all prior to that jobs report coming out that you just alluded to. And so
Exactly.
they are likely changing this as well.
Yes.
And the importance for investors is we were fortunate to receive nice high income last year from our bonds, our fixed income.
Even
But
cash.
and cash, of course. And then this is the environment now where when we start cutting, we get to gain an appreciation on top of that as well. So,
For bonds specifically, absolutely.
yeah.
Yep.
Yep.
Cash, you'll just see rates decline. Prices don't move, but the rates will just go lower immediately. On values will go up
Correct.
because of this.
And we'll talk about cash in a second, but one more issue in regards to the Fed. We titled this slide Jawboning.
Yeah. Well, we joke because the Fed has also admitted that one of their tools, quantitative easing, buying bonds in the open market, providing liquidity, cutting rates, increasing rates, right? One of the other tools is talking. Their words go a long way. If they talk very aggressively, very hawkishly, the market listens, the bond market listens, the economy hears it, and it alters the path. It alters the price of various securities. If the Fed is very dovish, we're going to cut rates to zero again. We're going to provide a ton of liquidity. We're going to do it very soon. Well, asset prices will reprice pretty quickly, in that case, in a positive way. There will be other policies that are updated, and there will be business decisions that are made based on the words of the Fed, not even the action. What we're seeing here is probably peak effectiveness of their words. So we think this is just about the last time they will be able to use their words before the markets stop believing them and start really just looking for action. But this chart, it's just over the past month. These are the odds of cuts for the various meetings throughout this year. And the Fed message coming out of February was vague, but the market was expecting more of a dovish tone. They shouldn't have, because the Fed did promise that, March is when there's going to be a real decision whether they do something or not. So no one should have expected a February cut or even a clear signal about the March meeting, which is coming up next week, mind you.
Mm-hmm.
But the odds of cutting changed pretty rapidly in the short months. So in March, May, and June, the odds really, really, really changed based on the Fed's lack of clarity around their statement and what they're going to do. And we literally went from a perfect example is May. The market had a 70% chance of cutting baked in February for the May month. And shortly after some of the Fed talk, post meeting, and then over the past week, the odds are now down to 25%. That's a pretty big swing.
Right.
It's a pretty big swing. If we checked it again today, which is now after Jerome Powell, the head of the Fed, spoke in front of Congress, the odds are now almost back up to where they were in February.
Okay.
So,
And mind you, they're talking about cutting rates. None of them are talking about raising rates.
exactly.
It's really the timeliness of it.
Oh, they're cutting. It's just
Mhm.
when do they start and how much do they do? But again, we think their words will not be as effective going forward because it's decision time.
And I think that's a good segue maybe into this next slide. I mean, we've been talking about how the Fed has been driving the markets now for almost a couple of years, really. And you can see that on this slide. This is actually really just showing from last September on the left, moving towards the right, but it's what the market is expecting in terms of Fed cuts in red. So anywhere from starting with 5 rate cuts in the fall, it's moved around. Right now we're sitting at 3 to 4 on the far right, but we're overlaid with the S&P on the blue. And you're seeing a massive divergence literally last month of the two. So I think to your point, we've been so correlated to Fed language, and finally the markets are moving in a different direction. And we think it's based on the fundamentals of corporations. And we've talked about this and we've talked about their strength.
Yeah, agreed. It's finally fundamentals are back. We've talked about this for months, but now there's a lag. When we talk about hey, fundamentals are good, you'll see it's because earnings reports that are coming out today are for last quarter, right?
Mhm.
Corporate cash balances, corporate decisions are a quarter old. So we started saying this over the past couple of quarters. Now you're starting to actually see the real data, again, backwards looking, that is proving that point. The blue line of the S&P is no longer moving up because of the Fed. It is moving up because of fundamentals. It's actually detached from the Fed language for the first time in a long time.
A long time.
And that's why I've said in the past that the market is being held hostage to the Fed's decision making. And again, that also reinforces the fact that while the market still listens to the Fed and digests the data and in a short day or week, reprices a little bit, it then looks at fundamentals and says, I'm going to price based on the fundamentals of the economy, the consumer, the mountain of cash, corporate earnings, earnings expectations, all the other good stuff that's actually happening. Finally, it has detached.
Yeah. And I think a great example of that is earnings. And if you look on the far right on this slide, we're looking at the earnings estimates as we complete 2023 and going into this year and next year.
Yeah, so it's a great chart. What you see here are actual earnings and year-end estimates. So you have 2023, and the reason why it's still an estimate is because the reporting season for 2023 isn't done. It actually ends in about 3 weeks. So about 95% of the S&P has reported their earnings. 5% is still outstanding for the final quarter. And then 2023 comes to an end. And it looks like we'll actually have 5% earnings growth, where most forecasters a year ago were forecasting anywhere between 5 and 15% earnings decline. We actually had a 5% increase in earnings. Big shocker. Part of the reason why the market absolutely turned around. And then in the out years, 2024, 2025, you have conservative estimates of just about 11% earnings growth and just about 13% earnings growth. Julina, we have always talked about this. The forecast is based on not only the analyst opinion, but where it comes from. The CFO and CEO of the company putting out the forecast.
Yeah.
And we have noticed, this is public knowledge, that whenever the companies themselves put out their estimate, they lowball it. The rationale there is most of the management team is compensated better if they beat their earnings.
Correct.
So there's a vested interest in padding the stats in a, very conservative way with their forecast. So what ends up happening is a company will report earnings. They've given themselves a low bar, but that low bar, they got all the analysts to believe it. And then the company comes in and they beat earnings. Like, wow, we can't believe we did this.
But I think that's important to know that they are conservative.
Very, very important. I believe the stat is something like 90% of the time, the actual annual earnings result is far greater than the forecast.
Yeah.
The only time it's not is when there's like a sudden bear market or a sudden economic shift. But even then, it's not clear cut. There are times, case in point, 2022, that was a horrendous year for the capital markets. The Fed increased rates by the most ever in the shortest amount of time in history.
Yeah.
S&P 500 grew earnings.
Exactly.
So there wasn't an earnings decline. Fact, it's right in front of us. So,
and it's just another reminder, these fundamentals are what drive the markets higher over the longer term.
yes. Yeah. Day to day, you don't have earnings releases every day for the entire market. You have some companies, but in aggregate, you have to wait a quarter to find out what the prior quarter looked like. It's stale, number one. Number two, it comes out slowly.
Yeah.
These are the things that should move the market on a daily basis. Unfortunately, it's not. It's computerized trading and emotion and rumor and options trading and derivative trading that moves it on a daily basis, which makes everyone think they're missing out on something or there's something that they don't know or something special that's happening.
Yeah.
Stick to the fundamentals, put your head down, don't look, and you'll make a lot of money over a long period of time.
Well, and speaking of the roller coaster of the market, we need to talk about behavior of bull markets because we do remind clients over and over again, it goes up and it goes down. However, there are these anomalies of time where it does kind of go a little straight, and we're going through it right now.
Yeah, so this is the streak of the S&P 500 without a 2% decline from a closing high. So, we told you last month or 2 months ago, you're going to hear all-time highs often. And you'll probably hear it so much over the next cycle, which we think will be 7 or 8 years, because that's what happens in bull markets. In a bull market, you reach the old high and then you push through it to create a new high. So when you look on any chart of the market, it goes up.
Correct. And the longer the time frame, the more that line looks smooth.
Correct. So what we show you here is something that's quite normal during bull markets. We've had about 90 days without a 2% decline from a closing high. So that means you'll hear stats like this on CNBC. It's the best day since yesterday. So stupid things like that. But, the market's up, whatever, 18 weeks, 18 of the past 19 weeks, 20 of the past 21 weeks, so on and so forth. Yeah, that's exactly what we're showing you in this chart. the market has been quite resilient, tolerating some of the weird messages, noise, policies, or stuff that's being floated around. We do think that, again, we're due for a bit of a breather, a small pullback very soon. But this does illustrate down on the bottom, we have the years, the bull market years, which we know is where you see this type of activity. In non-bull market years, this is abnormal. In bull market years, this is actually quite normal.
And Bob, you just mentioned a possible pullback. So if we can maybe talk a little bit about that and why that may be due.
Yeah, so here is a chart of presidential election years, which can also be sort of matched with the fourth year of a new president,
Hmm.
and sort of glue that together and show a back test over a calendar year. And the average calendar year is about 12.2% for that type of period. And you see that the blip is usually in the spring.
Yeah.
But historically, we can use any year, and there's usually some blip right around tax time. And tax time will define as mid-March to late April for those
Yeah.
who are a little late paying their taxes. And that's real because some of that money, there's a ton of money, more money than ever in history, paying tax. And some of that money actually comes out of the capital markets, believe it or not.
And
So
it's an interesting point, and I also think the other point of this slide too is in an election year, as it becomes so emotional, as we know it will this year, isn't it interesting to see that historically the markets gain strength as we go towards the end of the year?
absolutely. Yeah. So regardless of changing politics, chance of changing politics, keeping it the same, all the noise, the market loves change. It doesn't matter what kind of change it is. If it doesn't get the change, it loves that too.
Mhm.
So
Yeah.
we specifically point out, right? So election years, you do have this lack of bad policy, lack of hard calls, lack of major decisions being made. Everyone gets the candy, everyone's a winner. That is part of it. And actually, there's a chart that we didn't show, but election years tend to be lower volatility years. How about that one? The society maximum volatility during election years, but in the markets they tend to be lowest volatility. You don't often see that. I can't say that in any other scenario,
Yeah.
but that tends to hold true in the capital markets during election years. So
It's interesting.
one thing we were saying about this market rallies, bull markets, what you need is you need a multi-week run and then a breather, a multi-week run and then a breather. You have to have these consistent 3 to 7% pullbacks to strengthen the core of the market, to allow itself to breathe and to not get overheated. And that creates a stronger, more stable, full participation rally
Mhm.
that becomes a multi-year bull market. So we really want to see soon the market take a breather. Julina, for people that don't know, is a triathlete who just competed in the Ironman down in Florida late last year. And you biked 100+ miles, you swam many miles, and then you finished it with a full marathon.
Yeah.
And you were telling us, showing us your stats, that you had slow laps, slow miles, a slow bike period
Yeah.
that allowed you to have a much stronger period during certain spots.
Yep. And if you got ahead of yourself, you had to back down. So
Absolutely.
so
So,
thank you
yeah,
for
we're
that.
hoping that the market doesn't get ahead of itself,
Yeah.
and hopefully we hit a little air pocket soon. That'll be very healthy for the market.
I personally love that analogy.
Great.
So let's talk about cash. And we have talked about this before, and I will say this again. If there is a reason for optimism going forward, in my opinion, it's the cash
Yeah, Cash Mountain has hit a new peak.
mountain. Yeah.
Yeah, Cash Mountain. So, fuel, this is a chart of fuel for a bull market. It always has been and very likely will be. This is the dry powder that has come out of bonds and stocks. It is now approximately $6 trillion. Now, what helped get it out of bonds and stocks is, a turbulent market back in 2022. Cash now yields something. It'll soon yield less, of course, but it wasn't the worst thing to do to have some cash hanging around. However, you have to keep in mind we do have a scenario where more cash than ever in the history of measuring it is sitting on the sidelines at the beginning of a bull market. So a lot of that cash missed out on a very strong rally since the beginning of last year and so far through the beginning of this year. The opportunity cost was high, but at least there was some return. Unlike in prior years where rates were zero, there was no return. So what's going to happen here? Well, what will happen is when the Fed cuts rates, it'll make cash significantly less appealing. Number one. Number two, those rate cuts will fuel the bond market and the stock market higher. And then the I'm missing out on it feeling will kick in shortly. And that doesn't end for years.
Right.
So this chart really charts out how much fuel there is for a bull market. And it will be deployed into stocks and bonds. Most of it will be probably over a 5 to 7 year period of time. And that is what helps propel the bull market higher.
Yeah, and I would also add, and we've talked about this in past webinars, that if you don't want to be late, and if by waiting you miss a lot of the opportunity that comes out of this, and you can also see that those two previous cash mountains that we have massively surpassed was the financial crisis of '08, it was the pandemic of 2020, and that gray line highlights the fact that it was coming off of a recession.
Yeah.
You can argue whether we had a recession last year or not, but again, we're seeing the same playbook play out.
Yeah. This is the inverse chart. You're supposed to buy the market when it's down and rebalance and take some off the top when it's high. This is the inverse of that. This is people stocking up on cash at the worst possible time when it should be deployed in the markets at low prices. It's being created when there are low prices.
Thank you for that. So I would say that we continue to have a lot of reason for optimism, whether it's the fundamentals, whether it's the cash. And we promised in the introduction, going through the agenda, that there were a couple of items that we wanted to catch attention to. So can we talk about these?
Yeah, we've been talking about everything is good, spring has sprung, earnings are good, so on and so forth. But keep in mind, we spend a lot of our time looking for bad news and looking for cracks in the foundation, actively seeking out, questioning big Wall Street firms. We do our own research on top of reading research that we pay for, on top of reading the free research that we get. And we're always looking for stuff. And there are a few things that popped out. We've noticed that, again, the Ivy League endowments, it's usually time for them to brag about their performance. We haven't heard anything, performance of their endowments. They have actually massively underperformed the markets, number one. Number two, a lot of that underperformance has come from the private equity exposure that they've had. So that to us is a little, not a red flag, but a yellow flag. So private investments are now delayed, of course, writing down some of their assets, marking them down. And that turns into performance way lower than expected. And you can see it right here in the endowments, because these endowments are the ones that have the most exposure to it. Number one. Number two, there's also something else going on. You have a lot of donors who have backed away from many of these institutions. So the long-term projections for many of these endowments has been altered with the short-term underperformance. They're now recasting their long-term forecasts for rates of return, mixed with the donations have dried up. So shockingly, now think about this math. You have Harvard looking to issue a municipal bond through the state of Massachusetts. So Harvard is looking to raise just under $2 billion at the highest rate environment that we've had in 20 years. That's interesting.
Mm-hmm.
I don't know exactly what that says, other than proof is in the pudding. Donations have dried up, and their performance has been not so good.
Right.
But it's very interesting to grab $2 billion or try to get $2 billion through a municipal offering through the state of Massachusetts. It's just interesting to me because you typically don't see that.
No.
And it's not project driven. It's not like they're building something. It is just to get money. Or if you ever borrowed money on the commercial side, it's general purpose borrowing,
Mhm.
which is hard to get.
Yeah.
So,
To your point about the performance, I think this is a very it's a starking, it's the wrong word. It's a glaring slide
yeah.
of their performance over the last 10 years, which is the dark blue, that's averaged, call it 8 to 10%
Oh,
relative
yeah.
to what they did last year, which is the green.
Yeah. I mean, if you're watching this and you're a client, congratulations. You all returned significantly better than all the Ivy Leagues who,
Yeah.
brag every 6 months about their performance. So
Yeah. Yeah.
applause for our clients. Yeah, I mean, Princeton was negative last year. I mean, that's hard to do. So what you're seeing here is, their long-term, very, very, very long-term forecast is 10-year, but 20-year looks exactly the same. They're, somewhere around 8 to 10%, which is, completely fine when you have a portion of your portfolio that's in private equity and you can make up the prices. We'll talk about that some other time. But long story short, the light blue on this chart is the short-term performance. The 2023 fiscal year is very different. So big eye opener here. More to come on this, but we just should mention it to you because there's something going on here. The next
Absolutely.
one, the next
Yeah.
topic, again, us doing our due diligence. We're always looking at municipal bonds for our clients, to see where there's an opportunity. We look at the market in general, and then there are sometimes some individual issues that pique our interest for one reason or another, whether it's good or bad. We stumbled across this one, and there might be more of this happening soon. So this is from NewYorkCity.gov. So this isn't us making stuff up. This is real. We didn't think it was real, so we had to fact check it. It's actually right from the government website, the New York
So,
City government website. So what you see here is a bond offering, a municipal bond offering, a pending municipal bond offering, looking to raise greater than $10 billion
mhm.
to cover the migrant expenses. So again, you're going to have the municipality, you're going to have a New York City, New York municipal bond, New York City bond, general obligation, general purpose bond issue
Mhm.
that the taxpayers have to pay for, issued again at the highest rate environment we've seen in 20 years. Now, Julina, we were talking about this. What's strange here is it's the first time we've seen it for general purpose, but the general purpose actually happens to be a specific purpose called migrant expenses. First time we've seen this, number one. Number two, this was coming at a time where all of the metro area cities or states that have major metro cities received an overwhelming amount of COVID support, COVID money.
Yeah.
They were swimming in cash just a year ago.
Right.
And all of a sudden, you're seeing debt issuance. So, more to come on this. And it might be a trend over the coming year or two or three. We don't know how the market is going to tolerate this or price it. We will let you know when we see it if this actually goes through. So you can check it out for yourself. The underwriting on this, if you're applying for a mortgage, what's the asset that's backing it? What are you going to use the money for if it's not asset backed, so on and so forth. This one's interesting
Yeah.
and we'll see if there's an appetite for it. So we're just pointing it out.
And what we highlighted for you in yellow, and this is New York City telling us that they've spent about 1.5 billion so far on this, and they're estimating an average of 4 billion for the next 3 years per year.
Yeah. So when we look in the municipal space or really even the corporate bond space, what are you doing with this money and how is it going to generate more revenue for you to pay the bond back? This one, there's no revenue generating activity.
Opportunity.
Yeah. So I just
Yeah.
this is going to be a very interesting offering. More to come.
More to come. And lastly, since we've already talked about the fact that it's an election year here, it's unbelievable that we're looking globally as to how many areas around the world are also going through an election this year.
Yeah, it's we call this one 2024 elections, everything everywhere all at once. Yeah, let's not forget it's not just the US, it's just about half the planet is
Yeah.
going through an election. we're going to go out on a limb and say there's going to be change somewhere. It might be in many places. So, what a great year for the media. So, advertising sales are going to go through the roof because there's elections everywhere. Keep in mind, it's not just the United States. This year is it's going to be a very big year for elections with just shy of 4 billion people expected to vote in various elections throughout the world. So more to come. You'll hear so much more about this, not from us. We'll scratch the surface maybe a couple of times just to stay relevant, but that is all we have.
Yep. As always, Bob, we appreciate the insight. It's interesting to see that we have kicked off 2024 in a way that you and I have talked about that we expected.
Yeah.
But it is still very early on, a lot more to come. And hopefully our clients and the listeners know that we are diligently looking at everything, and we will come back and share more each month for you. So for anyone that has any questions, if they have any issues, please feel free to reach out to us here at Principal Wealth. We're here for you.
Great. And we'll see you next month.